Hello and welcome to our conversation on the financial statement analysis. In this session, we will try to examine the working capital and the current ratio as a part of the liquidity analysis, get an understanding of different situations of the working capital and the current ratio. Let us see some hypothetical situations. Suppose we know that the working capital is the excess of the current assets or the current liabilities, and current assets consist of all those assets which can be converted to cash within a period of 12 months, and current liabilities are the liabilities payable within a period of 12 months from the date of the preparation of the balance sheet. So we can see that in this example, in case 1, working capital is 150,000, and the current ratio, which is a CA by CL, current asset by current liability. In this case, it is 1.3, and the liquid ratio is by removal of the inventory, the least liquid asset from the current asset, and calculating the ratio between the current assets minus the inventory divided by current liabilities. Whereas the absolute cash ratio is relationship between the cash and the liabilities. We can see that in this situation, in the case 1, the working capital is 150,000, current ratio is 1.3, liquid ratio is 1.2, and absolute cash ratio is 1.0. But observe this, in case 2 also, we have the same situation. Working capital is positive, CR and LR and AB SCR are exactly same. But in order to understand the working capital, in order to understand the current ratio, is always better to see the composition of the current assets and current liabilities. So in the first case, can we just have a look at it? The current liabilities, a significant part of the current liabilities is a bank overdraft. The bank overdraft is a very costly short-term loan. So therefore, even if the current ratio is 1.3, because the current bank overdraft is accounting for significant part of the current liabilities, the business has to deal with the payment of the the bank overdraft depending on the cash. So here you can see that the current asset, a significant part of the current asset, is also cash. Observe in the second case, the bank overdraft is 0, whereas the advance from customers is 400,000. Though the working capital is same, the current ratios are same, the nature of the balance sheet conveys the composition of the current assets and current liabilities, gives us a different picture here. What is that? That means in this case, the company has collected money from the customers, which will be used, which is in the form of cash now, and which will be used to buy inventory, to convert into the stock and sell that. Whereas in this case, the current asset and current liabilities composition is tilted towards bank overdraft, and the company is sitting on this cash, and unless they use the cash properly, they will the liquidity position may get into a difficult situation. In the third case, you observe here, there is no bank overdraft, there is no advance, the working capital is same as the previous 3 situations, but here the provisions are. What are these provisions? In the first 2 cases, there is no provision. Short-term provisions or current provisions are actually creation of a part of the profit is transferred to meet some future expenses, maybe provision for bad debt, maybe provision for repairs, maybe provision for other expenses. So unlike the previous 2 situations, the working capital is same, but the composition of the current liabilities here, it is not bank overdraft, not advance, but provision, which is more a book entry. Let us see a fourth case. In this case, a significant part of the current liability is trade payable, creditors, and in the current asset, it is 550,000 is a debt. So therefore, even if the current ratio is same as in other three situations, but here the composition of the current asset is not giving a liquid picture. In other words, a significant part of the current asset in this case is in the form of an asset which is not as liquid as cash or as liquid as maybe the other near cash and near cash item. So it is necessary, therefore, even if you have the same current asset and current liability, same amount, working capital is same and the current ratio is same, it is not advisable to come to a conclusion that the liquidity position of the company will be same. It is necessary to observe the composition of the current asset and current liabilities to take a final decision on the liquidity. For example, if the current liabilities is in the form of bank overdraft, which is the case here, and this is an interest-bearing liabilities, whereas the trade payables, salary payables, advance from customers in most of the cases, and the provisions are non-interest-bearing liabilities. If working capital, if the current liabilities are high, because of the interest-bearing liabilities, current liabilities, then there is a need to have significant part of the current assets as liquid current assets so that you can make the payment of the bank overdraft on time. Let us take another situation. Okay, suppose with one of these balance sheets, we have at present working capital is negative. Okay, working capital is negative because you have taken, the company has taken a short-term loan. You see this? The company has. And what did they use the short-term loan for? The short-term loan has been used to purchase a plant. Okay, so you may ask, why did they use the money to purchase? Maybe they want to use the existing cash for some other purpose. So in this case, it's very clearly visible the working capital is negative. And suppose we have, I'm just trying to create the meaningful balance sheet for us. So 550, okay, and this is 100,000. Okay, so the company is not having sufficient cash, so they borrowed the cash through a short-term loan. So therefore, the short-term loan has increased because they wanted to buy the asset, and that asset is now, see, plant has become 13,000, and they use that excess cash they got to buy a property, plant, and equipment. Now observe this: the working capital has become negative. Sometimes we can interpret the negative working capital as that a part of the current, part of the non-current assets have been utilized, have been financed by the current liabilities. So will the company continue to do this? That we don't know, but it is possible that because the organization of the company required cash to buy the asset, and maybe it will take time to get a long-term loan or to raise equity, so therefore they borrowed a short-term, made a short-term, arranged short-term loan, and immediately used the money to acquire the asset. So who knows, in the next time period, they raise money from equity or some long-term loan and pay off this short-term loan. So therefore, In order to interpret current liability and current asset, one need to examine the composition of current assets and current liabilities to get a better picture about the liquidity. Now let us see the current asset and current liabilities, working capital, and the current ratio of some of the well-known companies. For example, in case of the Jubilant Foodworks, the working capital has, in both the years, has been positive. Okay, so current assets, significant part of the current assets, we can have a look at the current assets of Jubilant and see what is the current asset of Jubilant. It is a significant part of the current assets is equal to what is the composition? They have cash sitting on the balance sheet, and Jubilant manages the Indigo, whereas the Burger King, you have the negative working capital. The negative working capital, it recently went for the IPO and wanted to raise equity, and there was an oversubscription of the public issue. So maybe in the next time period, in the next year, March 20, the nature of the balance sheet, the composition of the current assets and current liabilities may change. Let us see the Tata Motors. Tata Motors consistently, all the 5 years, has been having negative working capital, and not only having negative working capital, is also the negative working capital is increasing. Let us see the composition of the working capital, that is current liability. Current liability, the significant part of the current liabilities are the short-term borrowings and trade payables. So that means the company is making lots of short-term borrowings and use that money to maybe to fund its own, the local regular operating expenses, or maybe to buy the other investments or other assets. What about HUL? HUL, once upon a time, is to have consistent negative working capital, but now working capital has become positive. So let us see the composition of the current assets of HUL. You will see a significant part of the working capital or the current asset will be cash and cash equivalents. That means the company is holding, sitting on liquid cash on the balance sheet, which is equal to approximately about 25% of the total assets are in the form of cash. What about Airtel? Airtel, we can see once again is having a negative working capital, and let us see the negative working capital of Airtel. The negative working capital is because all through the current liabilities have been rising, and 93,000 crore, and out of that they have provisions, okay, they have the trade payables and short term. There is a need to understand what are the short term provisions, okay. Maybe it's some cases there, or provisions to meet some of their unexpected expenses which they are predicting, which may happen in the next time period. So therefore the current liabilities of Airtel has been consistently rising. But let us now observe the working capital of some foreign companies like Tesla. Tesla working capital has been positive and negative in the last 4 years, and 17 and 18 has been negative, and whereas 19 it has become positive. Amazon, all through the working capital has been positive. So it is necessary to observe the composition of the current liabilities and current assets to understand the position of liquidity. What about the Facebook? We can see that Facebook is also having a positive working capital for the last 4 years. So there is a need. Let us see the composition of the current assets. A significant part of the current assets are short-term investments, and cash. So, and we know that Facebook has been making profit, is a profit-making company, though we don't have the profit and loss account here, income statement, but we can see the equity of the company rising. So the objective of this particular short presentation is that in order to comment upon the current ratio and working capital, it is necessary to understand the composition of the current assets and current liabilities. So the current assets, you have to check the liquid and illiquid current assets. And current liabilities, we need to check the interest-bearing current liabilities and non-interest-bearing current liabilities before we understand and comment on the liquidity position of the company. Thank you very much.